Welcome to Intellectuals with Qasim. Today you will learn how to achieve financial freedom, something never taught in schools, colleges, or universities: the psychology of money. A deeper chapter-by-chapter analysis. In 2014, a janitor died and left behind an $8 million fortune. No lottery ticket, no inheritance. He swept floors and pumped gas, and quietly outinvested most Wall Street professionals. Around the same time, a Harvard-educated finance executive with a six-figure salary filed for bankruptcy. Same country, same decade, same access to the same stock market. So what actually separated them? It wasn't IQ. It wasn't which Ivy League school they went to. It wasn't even how much they earned. Today, I'm breaking down The Psychology of Money by Morgan Housel, one of the most talked about finance books of the last decade, and the 20 brutally simple lessons inside it that most people learn the hard way, if they learn them at all. Because here's the uncomfortable truth this book makes. Managing money well has almost nothing to do with math. It has everything to do with how you behave, under stress, under pressure, and when no one's watching. Stick around, because lesson number 3 is the one that ruins millionaires, and it's probably already working against you. Housel's central claim, and the thread that ties all 20 chapters together, is this: doing well with money is not primarily a technical problem. It's a behavioral one, the greatest show on earth. Housel notes that money touches literally everyone, yet almost no one is taught to think about it the same way. He contrasts medicine, where trial and error over generations has produced real, measurable progress, with personal finance, where he sees little evidence that decades of smart people going into finance. He cites financial engineering, once being Princeton's most popular engineering major, has made ordinary people better savers or investors. His diagnosis: money is taught like physics. Rules, formulas, save 10%, keep 6 months' expenses. When it should be taught like psychology, because knowing what to do tells you nothing about what happens in your head when you try to do it. Well, now I will explain 20 remarkable lessons mentioned by Morgan Housel. Lesson number 1. No one's crazy. Housel's opening argument is that financial behavior that looks irrational to an outside observer is usually perfectly logical given the observer's own life experience. And everyone's experience is different. He leans on a 2006 study by economists Ulrike Malmendier and Stefan Nagel, who found that people's appetite for stocks versus bonds later in life is driven less by financial sophistication than by what the stock market and inflation were doing during their formative young adult years. He illustrates the same point through John F. Kennedy, who, running for president in 1960, had to answer why he had no real memory of the Great Depression. His family was wealthy enough that the era barely touched them, unlike most of his generation. Housel's point isn't just people differ. It's that your own 0.00000000001% slice of world history quietly forms roughly 80% of how you believe the world works, which should make everyone a little more humble about judging other people's money choices. Lesson number 2. Luck and risk. Bill Gates attended one of the only U.S. high schools in the 1960s with a computer available to students. Pure chance that let him log the practice hours that eventually fed into Microsoft. Housel pairs luck's story with its equally powerful, equally unappreciated sibling, risk. Both mean that outcomes are shaped by forces the individual doesn't fully control, so we should be cautious about crediting success purely to genius or blaming failure purely on incompetence. His practical advice: study broad, boring patterns rather than idolizing extreme outliers, the Bill Gateses, the Warren Buffetts, and build a financial life that has enough cushion to survive being wrong. Because you often can't tell luck and skill apart until much later, if ever. Lesson number 3. Never enough. The chapter opens with a story John Bogle liked to tell. At a party thrown by a hedge fund billionaire, Kurt Vonnegut points out to Joseph Heller that their host made more in a day than Heller's novel Catch-22 had earned in its entire history. Heller's reply: that he has something the billionaire will never have, enough, becomes the chapter's organizing idea. Housel illustrates the danger of a moving goalpost with two men who already had everything and still risked it all. Rajat Gupta, a McKinsey CEO worth roughly $100 million, who fed insider information about Warren Buffett's Goldman Sachs investment to a hedge fund manager and went to prison for it. And Bernie Madoff, whose legitimate market-making business was already making him $25 to $50 million a year before he ran his Ponzi scheme. Housel's question: why would someone with hundreds of millions risk everything for more? Leads to his two takeaways. The hardest financial skill is getting the goalpost to stop moving, and social comparison is a game with no ceiling. A $500,000 salary rookie baseball player looks poor next to a $36 million a year superstar, who looks poor next to a $340 million hedge fund manager, who looks poor next to Jeff Bezos, a ladder nobody reaches the top of. Lesson number 4: confounding compounding. Warren Buffett's roughly $84.5 billion net worth at time of writing, Housel points out that the overwhelming majority was earned after his 50th birthday. Not because his strategy suddenly got better, but because he'd been compounding since he was 10 years old and simply kept going for over 7 decades. The real driver of his fortune isn't investing skill so much as being a phenomenal investor for an unusually long time. Compounding is unintuitive precisely because it's not linear. Our brains extrapolate in straight lines, so people chase big one-time returns instead of appreciating that pretty good returns sustained for a very long time beat spectacular returns that can't be sustained. Lesson 5: getting wealthy versus staying wealthy. Housel tells the intertwined stories of 1929 era speculators. Jesse Livermore shorted the crash and made the equivalent of over $3 billion in a single day. Then, high on confidence, kept taking bigger and bigger risks until he lost everything and eventually died by suicide. Abraham Germansky, a real estate multimillionaire, was ruined outright in the same crash and vanished, last seen shredding ticker tape on Wall Street. Both men were excellent at getting rich and equally bad at staying rich. Housel's argument: building wealth requires optimism and swinging for growth, but keeping wealth requires the opposite skill set: humility, fear, frugality, and the recognition that you can't compound money you've lost. Survival, not aggressive growth, should be the actual foundation of a financial plan. Lesson number 6: tails, you win. Art dealer Heinz Berggruen, who fled Nazi Germany in 1936, built a legendary collection and fortune not by being right every time, but by buying broadly and letting a handful of extraordinary successes, Picasso, Klee, Matisse, cover for a much larger number of mediocre or failed purchases. Housel generalizes this into a rule about investing in business. A small number of tail events like Amazon or Apple within an index, or a handful of blockbuster drugs within a pharma company's pipeline account for the overwhelming majority of total returns. This reframes what good investing decisions look like. You can be wrong most of the time and still do extremely well, as long as you stay in the game long enough for your rare big wins to play out and don't let a string of small losses knock you out first. Lesson number 7: freedom. Drawing on psychologist Angus Campbell's 1981 research into what actually predicts well-being, Housel highlights one dominant factor: a strong sense of controlling one's own life beats income, education, or even geography as a predictor of happiness. He shares his own short-lived stint as a college-age investment banking intern work he loved. On a schedule, if you don't come in Saturday, don't bother coming Sunday, that made him miserable, illustrating the psychological concept of reactance. People resist even things they'd otherwise enjoy once those things feel imposed rather than chosen. He contrasts this with musician Derek Sivers, who spent 2 frugal years saving specifically so he could quit and never need an employer again the moment, Sivers says, that actually changed his life, not selling his company years later. Housel's larger point: despite median U.S. income roughly doubling since the 1950s and homes growing nearly 2.5x in size, self-reported stress and worry haven't fallen because more of that wealth has gone into stuff and comparatively little into buying back control of our time. Lesson 8: man in the car paradox. Housel returns to his valet years. People assumed that driving up in a Ferrari would make onlookers admire them. But Housel, doing the actual gawking, admits he never once thought about the driver, only imagine myself in that car. The paradox: buying status symbols to earn other people's respect usually fails because the people you're trying to impress are mentally substituting themselves into your shoes, not admiring you. If respect and admiration are genuinely the goal, Housel argues humility, kindness, and warmth earn far more of it than horsepower ever will. Lesson number 9. Wealth is what you don't see. Housel describes Roger, a valet stand regular around his own age, who drove a Porsche until one week he showed up in an old Honda, having had the Porsche repossessed without a trace of shame. The lesson: a $100,000 car tells you only that its owner had or borrowed $100,000, nothing about what they've kept. He sharpens a distinction between rich, visible, current income, easy to spot, and wealthy, invisible, unspent assets hidden by definition. He cites the story of Rihanna nearly going bankrupt from overspending and suing her financial advisor, whose blunt response was that she'd been told plainly, spend money on things and you'll end up with the things, not the money. Because wealth is deliberately invisible, it's also hard to learn from by imitation. Ronald Reed, Chapter 1's janitor, was nobody's role model while alive precisely because his wealth wasn't visible to anyone, including people who knew him. Lesson 10. Save money. Housel uses a surprising analogy. The 1970s oil crisis wasn't solved mainly by finding more oil. U.S. oil and gas production rose 65% since 1975, but energy efficiency more than doubled over the same period, meaning conservation, not extraction, did the heavier lifting. He maps this directly onto personal finance. Investment returns are largely outside your control. Markets may or may not cooperate, but your savings rate is entirely within it and has a 100% chance of working every single time. Wealth, in Housel's framing, is simply the accumulated leftovers after you spend what you take in, which is why building it depends far more on frugality than on income or investing brilliance. Crucially, he adds that enough is relative to what you need, so keeping your own desires in check functions as a second, equally powerful savings lever. Lesson number 11. Reasonable, rational. Housel argues you don't need the textbook optimal financial strategy. You need one you can actually stick with when things get emotionally hard. His example: paying off his mortgage early, even though historical market returns suggested investing that money instead would likely have produced a better mathematical outcome. He did it anyway, for the psychological freedom of being debt-free, and doesn't regret trading a few percentage points of theoretical return for peace of mind he could sustain for decades. A reasonable plan you'll follow through market crashes and personal doubt beats an optimal one you'll abandon under pressure, because an abandoned strategy earns you nothing. Lesson number 12. Surprise. History is a flawed guide to the future precisely because the events that move markets and economies most are, almost by definition, things that had no real precedent, the outliers that break the pattern rather than confirm it. Relying too heavily on back-tested historical data creates false confidence. Models built entirely on the past are structurally blind to the next genuinely new shock, whatever form it takes. Lesson 13. Room for error. Housel opens with a striking WWIE anecdote. A German tank unit near Stalingrad sat mostly disabled, not from combat, but because field mice had nested inside the vehicles during a quiet stretch and eaten through the electrical insulation. The world's most sophisticated military equipment defeated by mice. His point: you can plan for every risk you can imagine, but the risks that do the most damage are often the ones too crazy to cross your mind. He draws a parallel from his own venture fund experience: startups undone not by competition or bad product market fit, but by burst water pipes, spoofed CEO emails, and freak local ordinance shutdowns. The defense against the unknowable isn't better prediction. It's avoiding single points of failure the way modern jets carry 4 redundant electrical systems, and, echoing Chapter 10, saving without a specific target because you can't build margin of safety for a threat you haven't imagined yet. Lesson number 14. You'll change. Long-term plans are fragile because people themselves aren't static. The end of history illusion: we look back and see how much we've changed, yet assume our current values and goals are basically final means the 25-year-old's 40-year plan is being built for a person who won't fully exist by year 40. Housel's remedy isn't to abandon planning, but to favor moderation and flexibility over extreme, irreversible, all-or-nothing commitments, leaving your future self room to want something different than your present self does. Lesson number 15. Nothing's free. Everything has a price, Housel argues, including strong long-term investment returns, and the price is volatility, fear, and periodic large losses. Many investors try to dodge this fee by market timing or bailing out during downturns without realizing that the turbulence is the entry price for the growth, not a penalty for a mistake. Reframing volatility as an admission fee rather than a fine something to be endured on purpose, not avoided, is, in Housel's telling, one of the most useful mental shifts an investor can make because it's what lets people actually stay invested long enough for compounding to work. Lesson number 16. You and me. Bubbles form in Housel's account because investors with wildly different time horizons are unknowingly playing different games while watching the same price. A day trader and a pension fund can own the identical stock with completely different definitions of a good price. When short-term speculative buying pushes a price up, longer-term investors mistake that momentum for a legitimate signal and pile in too, inflating the bubble further. His practical advice is to explicitly write down what game you are playing. He shares his own one-sentence mission statement as a long-horizon, passively invested optimist about global economic growth, so you're not blown around by headlines and price moves that belong to an entirely different, faster game than yours. Lesson number 17. The seduction of pessimism. Housel opens with historian Deirdre McCloskey's observation that people inexplicably like hearing the world is going to hell. He shows how asymmetric this bias is with a real example. On December 29, 2008, near the depths of the financial crisis, the Wall Street Journal ran a front-page story taking seriously a Russian professor's prediction that the U.S. would fracture into 6 pieces by mid-2010. Housel contrasts this with a thought experiment. If someone in defeated, starving 1946 Japan had accurately forecast the next 40 years, a 15x larger economy, near zero unemployment for decades, a booming stock market, they'd have been dismissed as delusional, even though that's exactly what happened. His explanation draws on Daniel Kahneman's work on loss aversion. Humans are evolutionarily wired to treat threats as more urgent than opportunities, because organisms that did so survived better. He adds a structural reason specific to money. Unlike, say, a hurricane which threatens a small fraction of the country, a recession or market crash can plausibly affect everyone. So bad financial news gets outsized attention and always seems to come with a tidy explanation, while good news rarely gets asked, why? Lesson number 18. When you'll believe anything. People fill gaps in complicated, uncertain topics, the economy chief among them, with simple, emotionally satisfying stories, especially stories shaped by their own incentives, biases, and desire to feel in control. This makes confident-sounding forecasters dangerously persuasive, even when they have no real predictive edge. Housel's implicit warning extends to the reader's own convictions, too. A good rule of thumb is to trust your own financial narratives a little less than you're inclined to, precisely because they feel so self-evidently correct from the inside. Lesson 19. All together now. Housel synthesizes the book's behavioral lessons into a short, practical checklist favoring humility about others' money choices, keeping ambition and expectations from outrunning satisfaction, prioritizing independence and control over your time above visible wealth, always leaving room for error, and choosing a reasonable strategy you can sustain over a technically optimal one you can't. Lesson 20. Confessions. Housel closes by opening up his own family's finances. They deliberately live well below their means and keep a large cash cushion that isn't earmarked for any specific goal insurance against an unpredictable future. And a way to avoid ever being forced to sell investments at the worst possible moment, he cites Charlie Munger's line about never unnecessarily interrupting compounding. He started his career as an individual stock picker holding roughly 25 stocks in his 20s. Mostly names like Berkshire Hathaway and Procter & Gamble, but has since moved the family's entire portfolio into low-cost index funds, investing a fixed portion of every paycheck without a specific dollar target. His summary of his own philosophy: he can afford not to be the greatest investor in the world, but he can't afford to be a bad one, so he optimizes for the highest odds of long-term success rather than the highest theoretical return. A brief history of why the U.S. consumer thinks the way they do. A historical closing essay tracing how the Great Depression, wartime industrial mobilization, and the GI Bill produced a uniquely thrifty, low-debt, high-savings, mid-century American consumer and how the decades since have gradually eroded that mindset through rising consumer debt and shifting expectations. Housel's point is that what many Americans treat as normal economic behavior was really the product of one unusual historical window, not a permanent baseline. What the book is really arguing synthesis. Read chapter to chapter. The book keeps circling back to a small number of underlying mechanisms. 1. Your experience isn't the world's experience. Chapter 1, the Kennedy Depression example, and the Malmendier-Nagel Bond v. Stock study both show that rational financial behavior is relative to a person's own narrow slice of history. 2. Outcomes are noisy luck and risk cut both ways. Chapter 2.6, Bill Gates' high school computer and Heinz Berggrun's art-dealing tales both illustrate that a small number of uncontrollable, high-leverage events, good or bad, dominate results far more than we credit. 3. What you keep matters more than what you make. Chapter 5, 9, 10, Livermore versus Germansky, Rogers' repossessed Porsche, and the oil efficiency analogy all point the same direction. Savings rate and survival instinct outperform income and cleverness. 4. Money's real product is autonomy, not stuff. Chapter 7, 8, the Rockefeller/reactance material and the man in the car paradox both argue that time and independence, not visible consumption, are what money is actually for. 5. Plan for surprise, not just for risk. Chapter 12, 13, 14, the Stalingrad Field Mice story and the End of History illusion both warn that the biggest threats to a financial plan are the ones you can't currently imagine, including the ways you yourself will change. 6. Emotional sustainability beats theoretical optimality. Chapter 11, 15, 19, 20, paying off a mortgage irrationally, treating volatility as an admission fee, and Housel's own boring index fund portfolio all make the same case. The best financial plan is the one you can actually stay on. In the end, The Psychology of Money isn't really a book about money at all. It's a book about behavior, patience, and the quiet discipline of leaving your ego out of your bank account. Morgan Housel spends 20 chapters proving the same point from 20 different angles. Getting wealthy and staying wealthy are two completely different skills. Luck and risk shape far more of our outcomes than we're comfortable admitting, and the goalpost of enough will keep moving forever unless you consciously decide to stop chasing it. The janitor who quietly built an $8 million fortune didn't do anything clever. He simply saved without needing a reason, avoided ruin, and let ordinary decisions compound for an extraordinary length of time, while men with every advantage. Ivy League degrees, 7-figure salaries, insider access lost everything because they couldn't tell the difference between what they needed and what they wanted. That's the real takeaway. Financial success has less to do with what you know and everything to do with how you behave when no one's watching. Whether you can control it long enough to recognize when you already have enough, and whether you're building a life that gives you freedom over your time rather than just the appearance of wealth to strangers who were never really paying attention in the first place. Read enough of these stories, and one truth becomes impossible to ignore. The tortoise wins, not because it's smarter than the hare, but because it never stopped moving, and it never bet more than it could afford to lose. If you like this book summary, then please subscribe, comment, and share it to your friends. See you in next video. Be happy, healthy, and wealthy. Thank you.